Welcome to Iron Financial. Our mission, as always, is simple: to help you cut through all the market noise, identify real structural strength, and forge a stronger portfolio. Today, we are cracking open the books on one of the biggest, most important companies on the planet, Amazon. And let me tell you, it's a company that just dropped an earnings report that, on the surface, makes absolutely no sense. You've got this record-breaking holiday quarter, numbers that should have had Wall Street popping champagne. But instead, we saw a reaction that was nothing short of a complete bloodbath. So what on earth is really going on here?
Okay, let's just dive right into the paradox, because that's what it is. You look at the report, and the headline numbers look incredibly solid. I mean, you see a company that seems to be firing on all cylinders, posting revenue figures that most countries would be jealous of, let alone other companies. But that's just one side of the coin. The market reaction was, well, it was brutal. This wasn't some little dip. This wasn't a minor pullback. The stock got absolutely hammered in after-hours trading. Wall Street took one look at this supposedly great report, and instead of cheering, they sprinted for the exits. That tells me the real story isn't on the surface. No, it's buried deep in the details.
And we need to be crystal clear about what hammered actually means in this context. We're not talking about a few $billion. We are talking about over $167 billion in market capitalization gone. It just evaporated in a matter of hours. So think about that. How does a company report a monster quarter, literally the biggest in its entire history, and get punished with a valuation drop that's larger than the entire GDP of many small countries? That's the paradox we have to dissect today. It just doesn't add up.
All right, let's start with the top line, because this is what should have been the good news. Revenue for the fourth quarter came in at a staggering $213.4 billion. The street was expecting $211.5 billion. That's a beat of almost $2 billion. Now, in this economic environment where every single company is fighting tooth and nail for every consumer dollar, that is a sign of incredible, undeniable strength. But the market just completely ignored it. All they saw, all they cared about was the right side of the screen, earnings per share. They reported $1.95 against an expected $1.97. Look, it's just a 2-cent miss. It seems tiny, right? But that single, tiny hairline crack was all Wall Street needed to see. It was the very first signal that the cost of generating all that massive revenue was starting to get out of control.
That's a fair point, but this is exactly where you have to look past that tiny EPS headline. You don't judge the integrity of a skyscraper by a single scuff mark on the wall. You analyze its steel frame. And for Amazon, that steel frame is built from two things: its absolutely colossal revenue stream and the real engine of the company, Amazon Web Services. So let's examine the actual structure here. Let's look at the sheer scale of this operation.
Let this number just sink in for a second. $213.4 billion in a single 3-month period. This right here is the first pillar of Amazon's fundamental strength. It's a testament to its market dominance, it's a testament to its logistical prowess, and its deep, deep integration into the daily lives of hundreds of millions of people all over the world. This number alone tells you that the core business, the massive machine that sells and delivers goods, is operating at a scale that is it's almost unprecedented in human history.
Okay, but a big number can also just be a stagnant number, right? Is the machine actually still growing, or is it just kind of running in place at this point? And that is the crucial question. The answer is right here on this chart. This isn't just a big number, it's a growing one, a 14% increase year over year. They added over $25 billion in new revenue compared to the exact same holiday quarter last year. This tells you the company isn't just maintaining its position on the battlefield, it's actively taking more ground quarter after quarter. And this brings us to what I believe is the single most important number in this entire earnings report: a 24% year-over-year sales growth in AWS. Let's be clear, Amazon Web Services is the engine room of this company. It's the high-margin, high-growth beast that powers not just Amazon's own massive profits, but a huge portion of the entire internet itself. Seeing this number not just growing, but accelerating, that should have been a massive flashing green light, a huge bull signal to the market. This is where the future of the company is being forged right now. And look, you don't have to take my word for it. The CEO, Andy Jassy, he said it himself in the press release. He explicitly called out that this is their fastest growth rate in over 3 years. That's 13 quarters. And he linked it directly to their rapid innovation, especially in things like AI and custom silicon. So this isn't some happy accident. It's a deliberate, focused strategy. The leadership team is literally pointing a giant neon sign at AWS and saying, "This is our strength, this is our future." Okay, I'll give you that. A strong steel frame is absolutely essential. But you know what? A strong frame is completely useless if there are cracks forming in the concrete foundation. And when I look at this report, I don't just see one crack, I see several, and they look like they're getting wider. So it's time to put the bull case on hold for a minute and talk about the red flags that the market actually saw, the things they reacted to. Okay, look closely at this table. North America? Fine, looks solid. AWS, as you pointed out, very strong, no argument there. But that middle line, that's the problem. International. Their operating income there fell. It went from $1.3 billion down to just $1 billion. That is not a rounding error. That is a significant 23% drop. In a world that demands global growth from a company like this, one of Amazon's key segments is actually becoming substantially less profitable. To me, that's a huge warning sign of slowing momentum and probably rising costs overseas. And this, right here, this brilliantly illustrates the absolute core of the bear case. That tiny 2-cent EPS miss we talked about earlier and this slowdown in international profits, they're two symptoms of the exact same problem. The market, especially in this environment, doesn't just want to see you get bigger anymore. It demands profitable growth. It wants to see that every new dollar of revenue you bring in is more profitable than the last one. And these numbers suggest that Amazon's incredible growth is becoming less efficient, more expensive, and for any serious investor, that is a major, major red flag. You know, those hairline cracks, they're concerning, for sure. But the real structural failure, what I would call the 5-alarm fire in this report, it isn't even in the income statement. It's buried in the cash flow statement. This is where the story goes from being a little disappointing to a potential catastrophe. We can forget about hairline cracks. This looks like a foundational collapse. Just look at that chart. Stare at it for a second. This is trailing 12-month free cash flow, the actual cash the business generates. In 2024, the company produced over $38 billion in free cash, an absolute fortress of cash. This year, just over $11 billion. That is a collapse of more than 70%. So the big question is, where did all the cash go? How is it possible for a company growing its revenue by double digits to see its ability to generate actual spendable cash fall off a cliff like this? To me, this is the biggest, most important headline of the entire report, and it feels like it's being totally buried under the big revenue numbers. This is the question that absolutely needs an answer. This isn't some small tech startup burning through venture capital to get off the ground. This is Amazon, a company that is supposed to be a cash-generating fortress, a financial bedrock. So what on earth could possibly cause a 71% drop in free cash flow? Is the business fundamentally less profitable than we've all been led to believe? Are there massive hidden costs that are spiraling out of control somewhere? I mean, this discrepancy is huge, and it needs a rock-solid explanation. And it has one. It has a rock-solid explanation. You're right to point it out, but this wasn't a collapse. This wasn't a 5-alarm fire. This was a deliberate, strategic investment decision. You're seeing cash disappear from one column on the spreadsheet, but you're not asking where it went. See, the cash didn't just vanish into thin air. It was forged into the hard assets that are going to build their future. Here's your answer. $50.7 billion. That is the year-over-year increase in what the company spent on property and equipment. That number right there is the direct cause of the massive drop in free cash flow. And where's that money going? It's not for more cardboard box warehouses or delivery vans. No, it's almost entirely for building out the physical infrastructure for artificial intelligence and cloud computing. We're talking servers, massive data centers, and developing their own custom silicon. And it's absolutely crucial to understand what this spending, what we call capital expenditures or CapEx, actually is. This isn't money being burned on Super Bowl ads or executive salaries. This is cash being converted directly into hard, physical assets. They are literally pouring the concrete and laying the rebar for the next decade of dominance in AI. You simply cannot lead the AI revolution without owning the infrastructure. And it's clear Amazon is willing to spend whatever it takes to build an unbreachable moat around AWS. And if you thought $50 billion was a big number, just get ready for this. The company explicitly guided that it expects to invest around $200 billion in capital expenditures in the year 2026 alone. This is not a one-time spend. This is a full-blown declaration of war. They are committing to outspend every single one of their competitors to win the AI arms race. This isn't a sign of weakness at all. It's a signal of extreme confidence and a long-term commitment to build an absolutely impenetrable fortress. A fortress or a tomb? A $200 billion spending plan is a monumental gamble. This isn't just a big bet. It's a bet that fundamentally changes the entire risk profile of this company. This transforms Amazon from a reliable cash-gushing giant into a high-stakes speculative construction project. What if they're wrong about the future? What if the return on that $200 billion isn't what they expect it to be? This isn't innovation. This is cash incineration on a scale we have never seen before in corporate history.
All right, it's time to weigh the evidence. We've seen the steel frame, and we've examined the hairline cracks. We've debated the foundation-shaking drop in cash flow and the massive bet that caused it. So, it's time for the iron financial verdict. When you cut through all the noise, is what's happening at Amazon an opportunity, or is it a trap?
So let's lay it out as clearly as possible. The bull case is this. You're looking at a company with unstoppable momentum. Revenue growth is solid, but more importantly, the AWS growth engine is re-accelerating in a big way. They're aggressively spending their cash, not because they're weak, but because they are strong enough to invest in dominating the next huge wave of technology, which is obviously AI. They are building a wider, deeper moat around their business. But the bear case is that the whole structure is on the verge of collapse. The core business is showing real signs of weakening profitability, especially in those international markets. And the foundation, their free cash flow, has been completely obliterated to fund a speculative $200 billion bet on a future that is very far from certain. This isn't a moat, it's a money pit.
So here's our final analysis. This isn't really about whether Amazon is a good or a bad company. The core e-commerce and cloud businesses are still an absolute fortress. The key takeaway, the most important thing to understand, is that the entire investment thesis for Amazon has fundamentally changed with this report. You are no longer buying a simple dominant play on e-commerce and cloud computing. You are now buying a high-stakes, very long-term capital investment in the AI revolution. The risk profile has gone way up, the timeline for potential returns has been extended by years, and investors must be prepared for significant volatility, for years of what we'd call construction noise, as the company completely rebuilds its foundation for the next era.
Which leaves us with the final crucial question. It's the one that every single investor now has to answer for themselves. After seeing the numbers, the growth, the cracks, and this colossal, unprecedented bet on the future, what do you believe? Is Amazon leveraging its immense strength and cash pile to forge an unassailable fortress for the coming age of AI? Or is this massive $200 billion project being built on a foundation that's already beginning to crack under the strain? The market has cast its vote for now, but the final verdict, that will be written over the next few very interesting years.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.